how big is the runway for foreigners to still plow into the Chinese sovereign debt market?
That's a great question. I think this is a multi-year process which is underway. I would compare this with China's WTO accession, except the integration is happening through capital market channels, especially the fixed income market. And even though the Barclays Global Ag Index inclusion is more or less done, the GBI EM index inclusion is more or less done, we still have the FTSE Russell index inclusion to happen later this year. And even if you just take a more holistic view of China's role and position in the world, we are looking at its GDP size, which is in the teens as a percentage of total global GDP, whereas the bond indices only have them at about roughly 5% or maybe a bit higher at the moment of their total index. So I think this is a multi-year process. And as you were highlighting, the yield differentials are definitely an advantage for continuing allocation towards China. And because this is a multi-year process, I expect the interest in China to remain firmly anchored. Now, there will be some pullbacks from time to time as U.S. rates begin to rise, or tapering begins in the U.S. at some point, maybe next year or so is our base case. But again, that should drive a process of more two-way flows, which deepens the bond markets in China, rather than resulting in any massive concerns about potential capital flight or anything of that sort.
That's a really interesting point. And I'll tell you what else has been a multi-year process, and that is, of course, the internationalization of China's capital markets. And so those capital controls have been eased, but by the same token, they could be tightened up again, potentially as a political lever, right? How great is the political risk for foreigners investing in China's bond market?
I mean, there's undoubtedly some risk, but I think there's a degree of selectivity here. One set of rules for domestic residents. I think the surveillance mechanisms are very carefully calibrated in terms of the bond connect, the southbound flows, and so on. From a political standpoint, I think it's important to keep in mind that hedging mechanisms and outflow and settlement mechanisms need to be in place to ensure continuing bond index inclusion. So from that perspective, I don't think there will be massive reversals per se. I think the bond market deepening, which is happening onshore in China, seems to be sufficient in nature to tolerate some volatility rather than having to resort to old-fashioned capital controls, which used to be the experience of the 1990s or early 2000s.